Hello everybody, a very warm welcome to SD Capital's official YouTube channel. Today's session is actually going to be part of a 4-session series. At the end of today's session, as usual, there will be a free stock recommendation. But before that, what is this 4-session series? This 4-session series is to provide pointers to beginners in the equity market so that they can start studying on their own and investing on their own. This is something SD Capital is doing as part of SD Capital's corporate social responsibility. We have actually started a Facebook group as well. The details will be provided at the bottom of this video, where we are doing the same thing over the month of August. So, let's get started. When someone enters into the equity market for the first time, what are the typical questions that plagues his mind or her mind? What to buy, when to buy. So this what and when basically answered by two different things, fundamental analysis and technical analysis. What are these? I will cover that in today's session. But before that, there is something worth highlighting right at this juncture. Investment horizon. If someone is trying to invest in the equity market for 1 month or a couple of months, for him or her, it is key that he or she pay more attention towards technical analysis. If someone is trying to invest in the equity market for 2 to 3 years time frame, it is imperative that he or she pay more attention to fundamental analysis. But SD Capital firmly believes there is no way to disregard one and just play by the other one. Fundamental analysis and technical analysis goes hand in hand. One has to master both to actually generate healthy returns from the equity market. Now, what is fundamental analysis? Fundamental analysis is actually looking inward into a company. What does it mean? Assessing the company's inner strengths and weaknesses. If the management of the company has got a vision, they have a clear plan, are they experts in their own field? These are some management related questions. Then there are questions related to financials, how the company is managing the balance sheet, how the cash flow statement is looking. These are the things which will give you the perspective from the financial side. Thirdly, does this company have a competitive advantage? Any proprietary technology, any new research, anything which gives it an edge over its competitors? These are the questions you need to ask yourself when you start fundamental analysis. In today's video, we are going to give you 3 pointers. Firstly, you need to look at the stock price movement for 3 to 5 years time, for the past 3 to 5 years. If a company has really strong fundamentals, then despite the market movements, all the jitters, if you look at 3 to 5 years price movement, there will be a steady upward curve. There will be jitters, but the overall movement will be really positive. That is a key indicator. Next thing, market capitalization. What is market capitalization? In plain simple English, it is number of stocks in circulation multiplied by the stock price. So typically larger the company, more number of shares in circulation, market cap is higher. We call them large caps. Then we have mid cap companies, then we have small cap companies, and then we have penny stocks. For example, Reliance, TCS, Infosys, these are big companies and large cap companies in the Indian market. So what makes it different? What makes a large cap company different than a penny stock? The movement, price movement. For large cap stocks, for these big companies, the price movement of the stock will be much more stable. It moves, but not really at a pace. On the other hand, penny stocks, it's a roller coaster ride. So if you are trying to invest in a penny stock, really brace yourself for a roller coaster ride. On the other hand, if you are going with large cap or mid cap primarily, you will see a steady growth over the months, over the years. That's how the whole thing works. The third concept today I'm going to discuss is the debt levels. Debt for a company is something very important for an investor to watch out for. Why? There are two aspects. Firstly, if for some reason the company liquidates, for some reason, some crisis, the company liquidates, whatever money can be retrieved, whatever asset can be salvaged, debtors have a higher claim. What does that mean? They will be paid back first, and then, only then, if there is something left, that will be distributed among equity holders. Because being equity holder, you are basically owner of the company. Debtors are third parties, so their claim is higher. The other thing with respect to debt is how the debt servicing is happening, or how that can affect. When we take loan as individuals, we pay interest. Same applies for companies. When they take loan, they have to pay interest. That is something we call debt servicing. Now, how do the companies do the debt servicing? Free cash flow generated from the operations is what they use to pay the interest of the loan. For some reason, if the company is not doing good temporarily, or overall economy is going down, pandemic situation, COVID-19, the company is not generating sufficient free cash flow from its operations, then it is in a liquidity crunch. And if it cannot do debt servicing, it may have to sell its assets under fire sale. It may have to take out loan from another source at a much higher interest rate. So these are the things typically which will affect company badly. But when you watch out for debt levels, you have to also make a note that debt levels vary from sector to sector, subsector to subsector. So it's not fair to compare debt level of a company in construction industry, where the debt level is typically higher, with a company which is in IT sector, where debt level is typically lower. So that brings the other perspective, which sector, which subsector the company is operating into. So you have to put, that is the context in which you have to judge. I believe these 3 pointers for fundamental analysis will give you a good starting point there. Now let me move to technical analysis. I said that fundamental analysis is something like looking inward. You are trying to actually find out strength and weakness of the company itself. Technical analysis is something like looking outward. That is where you are trying to see how overall market is moving, how the sector, subsector is moving, and then finally how the company is moving. So this is something all about price movement, the direction of the price movement, as well as pace of the movement. In theory, when investor buy a stock and the price level goes up, then you sell at a higher price and you book a profit. In theory, if price is going down, you sell the stock and then you do a short covering and you make money. But there is one very important thing which I'm going to discuss for next few minutes today. In real life, prices move sideways as well. When I say sideways, what happens basically, for a few weeks or few months, stock price for a particular company may move into a price band. So it is moving, it is going up and down, but it is not reaching two levels, one top level and one bottom level. The top level is known as resistance level, the bottom level is known as support level. So stock price is moving, but it is range bound. It is moving in a price channel, in a price band. As investor, you have to make a note of these levels, because there are two things to watch out for. That is, when it is breaking its resistance, when it is breaking its support level. If price of a stock breaks through the resistance level and there is enough trade volume, that means people are convinced about strength of this company and prices will go up in near future considerably. That's when you can start investing in the company, and in near future you can book some profit. When the price level is going bottom, crossing the bottom level, going through the floor, that means people are convinced that the company is not going to do well in near future. If there is a high trade volume at that juncture, people can short sell and book profit. But SD Capital will issue a warning at this stage for all beginners. Please stay away from short selling unless you yourself is convinced that you know the art. It is a tricky business. It takes a lot of expertise. So if you are a beginner, it's better to stay away from short selling. Experienced traders, expert traders also make money when price is moving in the price band. How? Simple, right? They buy at when the price is near the support level, they sell when the price is at resistance level. To do that, you have to maintain very strict stop loss price. You have to be very careful, and you have to maintain a target sell price, because if you don't maintain these prices, then your investment may lose value in no time. So you have to be very, very, very careful. I believe this will give you a good pointer to get started on technical analysis. So as I said in the beginning, we are doing more sessions in our Facebook group. We are now next 3 sessions on our YouTube channel will also be about fundamental analysis and technical analysis, some more concepts coming your way. So today's session now comes to an end. Time for the free stock recommendation. And today's free stock recommendation is SAIL. SD Capital's research team has reasons to believe that SAIL will go up considerably in near term. So if you are following our YouTube channel, please feel free to invest in SAIL. Obviously, the target buy price and target sell price, stop loss, all those will be shared with our clients. But as you have seen in past, our free stock recommendations have generated significant profit in past. Thereby, please feel free to buy SAIL if it works for your portfolio. So far, that's all today, really. Corona is still prevailing, so please take care. Please be safe. Stay corona free. Thanks. Bye.